Welcome back, dear listeners. In this video tutorial, we will be discussing profitability ratios. But before going to discussion of profitability ratios, conceptual point of view, we will be talking on why profitability is so important for different stakeholders. Initially, investors will be concerned about profitability of the business because they will be looking, if we invest in this business, then how much profit is going to be returning back to them. That is why investors will be concerned about profitability ratios. Second main stakeholder is creditor. Here, creditor means the one who gives loan to the company. So creditors pay attention to make profit because huge importance is placed on making profit in the marketplace. Because creditors are concerned about their return on investment. Here, return on investment mean what the company will give them as return to their investment. That is why creditors are also looking for profitability ratios. And there are so many important stakeholders in calculation of profitability ratios. One of them is management and employees of the business as well. So there are a lot of stakeholders in calculation of all these formula which are under the head of profitability ratios. Let's discuss the first formula of profitability, which is gross margin. Another name of gross margin is gross profit ratio. The formula is gross profit over net sales times 100. What is the meaning of this formula? Let's talk on this. Here, gross profitability ratio gives you the understanding how much gross profit is on every $100 of sales. I have taken 3 years data from 2008 to 2010 and answers which I calculated with the help of this formula, which can also be calculated as if the gross profit is not given to you, then you need to calculate gross profit first. Sales minus cost of goods sold will be equal to your gross profit. So here I have calculated and I have taken these figures from the annual report of a particular public company, and answer I calculated 12.42%. In 2009, I calculated an answer is 12.01%. And in 2010, the answer is 9.72%, which means on every $100 of sales, gross profit is 12.42%. And in 2009, the gross profit is 12.01%. On every $100 of sale, gross profit is 12.01. Now, looking at the comparative analysis under the head of this graphical representation, as compared to 2008, 2010 gross profitability is dropping because in 2008 gross profitability percentage was 12%, and now it is 9.72%, which is 3% or approximately 2 point something percent as compared to 2008. Next is net profit margin or net profit ratio. The formula is net profit over net sales times 100. Here, 3 years data have been taken and 8% is the answer of 2008. Is 8% mean on every $100 of net sales, net profit is 8%. In 2009, net profit margin is 9.05%. But in 2010, net profit is 9.62%, which is on the average we can say is consistent ratio. Next is return on equity. Return on equity means return on shareholders' equity. Here, equity can be calculated as I am giving you the formula of calculating of equity. I'm writing, just note it down. Shareholders' equity mean the amount of money which is raised through issuance of shares, plus all reserves and surpluses are also the part of shareholders' equity. So we will take the formula net income, or you can say net income after tax, over shareholders' equity. It gives you the formula And the answer of 2008 is 0.20, and 2009 0.17 and 0.13. What is the interpretation of all these figures? Let me explain it to you. On investing every $1 of shareholders' equity, 0.20 is the net income. So after investing every $1, you are getting 20.20 on every $1 of shareholders equity. Same is the case with 2009 and 2010. But comparatively looking, return on equity as compared to 2008, 2010 is not so good year as compared to previous 2 years. Thank you very much for watching this, and wait for my next video.